let the data themselves to what they need to convince them of, and then we'll normalize later in the year, and then we can all just move forward.
So, Tom, do you agree with that? I mean, you agree that Waller might be jumping the gun here with calls for July?
You know, I think if we looked at the Fed's framework that they've repeated in statements over the last 8 meetings about data dependence, then they should have cut, or they should be cutting in July. So I think this last meeting seemed to have changed the guideposts from data dependence to forward-looking expectations around tariff inflation that I think is why markets are starting to question the Fed's rationale. And Professor Siegel points it out, long-term inflation expectations are lower today for 1 year forward than they were in December. So we've gone through a full tariff liberation day and expected inflation's lower. Yields are actually lower. I think the market is moving ahead of the Fed and saying the Fed should be cutting sooner.
So at what point is the market going to get, Tom, too upset by the pace that appears to be slower than it would like?
Well, there could be an accident, right? Because I think what we are ignoring is housing is choking and collapsing under the weight of higher interest rates. And the labor market isn't as strong as it appears. I mean, when we look at the ability to get a job, it's much harder. So as Professor Siegel says, there's long and variable lags. There could be an accident where the Fed will have to panic. So I think that's something we have to watch in the incoming data.
When you say accident, what do you mean? On the long end of the curve, like rates go up too much? What do you mean?
No, I think that there could be a point where the Fed suddenly realizes the risks are actually to the downside for the economy weakening. And so the Fed will actually have to respond to an economy that they're strangulating and really fighting what they believe is a supply shock inflation. So I'm a little concerned that the Fed could be late if they continue to hold.
Professor, I guess you share that point of view. I would also ask you about, rates moving the way they are post Powell. Is there a level in your mind that the stock market just doesn't want to handle? Is it 5% on the 30-year? Where are we now? 492, 3 in that ballpark? The 10-year's not that far away from 4.5 again.
Yeah, 10-year has been range bound. I like to say that the Waller position is a minority position on the Fed, but I'm glad that he was first out of the box to make that position. I think there will be a growing group of advocates on the FOMC for his position over time as they see that, outside of the tariffs, and by the way, there is a lot of mitigation on the tariffs. I believe that a lot of firms could accelerate AI to offset a lot of the costs that tariffs are going to impose, and I think that the market thinks so also. I still will be a bump on that tariffs, but it won't be as bad, certainly, as inflationary expectations from the public is in the short run, and perhaps even from the Fed. And then when they look at the slowdown that the economy is likely to undertake because of being so high above the neutral rate, I think they will act. But I agree with Tom. They were real late on the upside. In 2021, 2022, they may be late on the downside. I don't think it's seriously late as they were on that downside. I'm glad Waller is putting in their ear, be on the lookout here.
Yeah. So given all that, it just adds to the uncertainty, the Fed's roadmap and the Middle East, you throw that into the mix too. We're not really sure what's going to happen there. What's your best idea now in light of all that?
Best idea is still AI. AI has run, but it's still, if you're looking 12, 24, 36 months out, it's still that AI trade. This is not like the late 90s. The player's not like the late 90s. The opportunity's not like the late 90s. This has legs. The AI diffusion, the Mitigation of AI Diffusion Act has given it legs, and we will continue to see AI. That is the U.S. secular robust trade. That is the trade that you need to be in if you're not in already.
Tom, you guys sound like you're sharing research.
Yeah. I broadly agree. I might add that I think interest-sensitive groups are going to benefit because they're going to start to look forward and realize the Fed If they are a little slower this year, they're going to be more dovish next year. That's good for financials. It is good for the industrials, really good for Bitcoin and small caps as well.
Professor, when you look at the tech trade, do you feel like the stocks are overvalued, or do you believe Harvey, which says, no, they're giving you every reason and they keep telling you and proving to you, including in the most recent earnings season, exactly why money should still go to those stocks?
Well, AI is very important, and certainly those companies, I think, will continue to prosper. But let's not forget about the AI users. And I think it's in the infancy of use to cut costs by regular firms that are not in technology. And I think in some ways tariffs might be one of the things that pushes them to more intensively use AI to cut costs. We saw during the pandemic, all of a sudden, people use Zooms. They saw, well, I don't have to have a business meeting, in Chicago or someplace around the world. We could use other technologies. That did cut costs at that time. And so the users could benefit in the future as much as the producers in the AI technology space. So, I'm very optimistic about firms implementing AI to cut costs, maintain margins, or even maybe expand them despite the tariffs.
Are we going to be okay, Chris, this next earnings season? We were better than expected in the last one.
Right.
And I don't know what's going to be in the next one, but what about this one that's coming up after the second quarter earnings?
I think so. Everything we're seeing from the consumer is still okay. You're seeing some weakness, but not a ton. CapEx still really strong. The shock from April really hasn't affected things all that much. I think if you have that weakness, but we get some progress on trade and tariff, people will look through it. But if you're asking the question, are numbers going to be solid? Numbers will be solid.
Yeah. Tom, you agree with that?
I do. I think companies have proven many times over the last 5 years that they are incredibly resilient and adaptive. This is really the fifth shock that they've absorbed. I do think one of the consequences of sort of surviving COVID and fastest hikes in history and now this tariff shock is that investors are going to start to assign higher multiples to the companies that are succeeding. So I do think PE expansion is a theme we should think about the next 12 months.
All right, we'll leave it there, everybody. Good weekend to all. Professor, thank you as usual, and Tom and Chris, we'll see you again soon. Let's turn now to Meta. Our Deirdre Bosa joins us now with the latest on Mark Zuckerberg's AI investing spree, and this scoop that you confirmed recently today, I think is very interesting because it's a name that's been bandied about in the last handful of weeks, at least, on who might be interested in it.
Yes, it is a darling as well, right, in the AI world. And so according to sources, Zuckerberg approached AI startup and darling Perplexity ahead of his Scale AI deal. Bloomberg first reported the discussions. One source tells me that it was Perplexity that walked away from the deal. Another, though, tells me that it was mutual. Either way, Perplexity adds to this growing list of Zuckerberg's big swings in AI, where he's not just chasing talent, but he's making a play for every layer of the stack. And when he can't buy a company like Ilya Sutskever's SSI, he'll settle for poaching its CEO, as Kate Rooney reported yesterday. Now, this all underscores a narrative, Scott, that I hear repeatedly from sources here, that Meta's campaign is about momentum, not coherent strategy. Perplexity, it's a consumer search AI app. Scale is AI infrastructure. SSI is a mission-driven research lab. They are very, very different companies. And taken together, this push looks less like a roadmap and more like strategic FOMO. In Zuckerberg's case, it could come off as just another rebrand without earning the trust or credibility that comes with it, which is why, Scott, he's had some swings and also some misses.
Maybe Zuckerberg is trying to get that asset, even though it was rebuffed, obviously, according to your reporting, before somebody else does. Maybe that's part of the whole thing. When we were sitting out at WWDC outside of Apple Park, in Apple Park outside HQ, Alex Kantrowitz was like, Apple should buy Perplexity. To him, that was a no-brainer. Yep. So I can't help but think that this is an attempt to get something before somebody else.
I've heard that as well, that an Apple needs a Perplexity or even an Anthropic, even though these startups, remember, they are climbing in value. There's so much money in private markets willing to go into them that it's a high price tag that, yes, only a mega cap can afford. But then there's the question is, do the founders want to sell to a Zuckerberg or a Cook? They're seen as behind and sort of jumping on this super intelligence or AGI bandwagon. A lot of these, the top, AI researchers that are fetching the highest salaries or the highest bonuses, they care about purpose, right? They're already making a huge amount of money. They want to go somewhere where they can achieve super intelligence. And that's why I think you see Sam Altman, Masayoshi Son talking it up a lot about this purpose. So maybe it's not just salary, but remember that these are researchers that care about the cover of Nature magazine or being cited. It's not just cap table to them.
Let's get quickly to one last story, which is a big talker out there, and I know it is, and it's about Coatue Management and Philippe Coatue, well-known tech investor, one of the best and brightest out there for sure, putting out its fantastic 40 list the other day, what they consider to be the next tech order. And the fact that Google is off of it. Microsoft, Nvidia, Bitcoin, Amazon, Meta, TSMC, Tesla, those are the first 7. I could go through many other names, which public and private markets. Alphabet is nowhere to be found. What do you make of that?
I mean, that is just flabbergasting to me. Whatever you want to say about Alphabet, maybe it's facing this innovator's dilemma, but it is firing on a lot of cylinders as well. And when you compare Meta, right, that's playing catch up and that's had problems with its latest models, its latest Llama models, but then you have Google, a Gemini model is, and this isn't me saying it, by benchmark, third-party benchmarks, is the cheapest and the best model on the market, beating even OpenAI and Anthropic's Claude latest models. I mean, it seems crazy to leave it off this list. And that's just AI. You got Waymo, which I spent a lot of time talking about, expanding rapidly this year. Maybe its search business could be hurt, but I think that covering this company day in, day out, they're doing a lot. It may not be the biggest and the brightest. It may not be number 1 on that list, but certainly it's got to be in the top 40.
I just think when Philippe Lafont does something like that and people hold him in such high regard on his views on tech, that's like a sit back and say, wow, of all the companies.
But Coatue, once was known as a tourist investor in Silicon Valley. They're not necessarily like an Andreessen Horowitz or a Sequoia Capital.
Dee, thanks. We'll continue to follow it. Deirdre Bosa to Pippa Stevens now for the biggest names moving into the close. Hey, Pip.
Hey, Scott. So Taiwan Semi is under pressure as the U.S. reportedly weighs measures that would terminate waivers, allowing some chip makers to send American technology to China. That's according to the Wall Street Journal. Chip controls, of course, a key sticking point in the tariff and trade talks between the U.S. and China. And CarMax is in the green after the company reported first quarter results that topped street estimates with an 8.1% increase in same stores used unit sales, making up for a slightly lower average selling price. Mizuho calling it a solid print and amid softening sentiment, with those shares up 6%. Scott?
All right, Pippa. Thank you, Pippa Stevens. Just getting started here. Up next, are stocks overvalued or not? We're going to ask the Dean of Valuation, Aswat Damodaran, next.
garden centers.
We are back. It's a question almost every investor is thinking about, given the uncertainty in the markets. Are stocks overvalued at current levels or not? Well, who better than the so-called Dean of Valuation to weigh in? Aswath Damodaran of NYU Stern School of Business joins us now. It's good to see you. What would your answer be?
Well, if you thought stocks were fairly valued at the start of the year, you got to think they're fairly valued still, because you come through a trial by fire, and it's amazing to me that stocks have held up as well as they have. But I think the answer is, in spite of all of the news stories we've seen, the earnings have held up, and the earnings hold up. I don't see why stocks shouldn't hold up as well.
So 22 times doesn't bother you when you assess where we are in the market?
Well, it didn't bother me at the start of the year. So if it didn't bother me at the start of the year, at this point in time, I've looked at what it's been able to do, the resilience, and 22 times earnings now might be what this market deserves, given that resilience. Maybe that's what we're paying for.
Well, I know, but things are different now than they were at the beginning of the year, obviously, given we didn't have tariffs at the beginning of the year, and we were far more optimistic about the economy and earnings growth than we are today, no?
Notwithstanding all the economic and the news story talk, the earnings don't reflect any of those fears we've held, right? We've talked a lot about the things we should be afraid of. And I would say since 2022, that's what we've tended to do. We've talked about things that bother us, but surprisingly, earnings and stock prices seem to be okay with them. So until they start to show up in earnings, this is, for the most part, more talk than real effects that should affect stock prices. So I agree with you, a lot more worries, but those worries are not showing up at the earnings.
Well, some say it's just a matter of time that, given the tariffs and earnings, it's not like I give it to you, the last quarter's earnings were obviously better than many people had anticipated, but it's not like they were knock it out of the park. I mean, the expectation is that in the coming quarters, that's when you're going to start seeing the potential lag effect show up. So you try and think of the valuation now relative to future earnings, not today.
And maybe the lack of credibility on the part of people who keep warning us this is going to happen is why the market's holding off. Maybe the market's saying, let's see if, in fact, we see this effect on earnings. Because, I mean, I can only count the number of times since 2020 where we want the next quarter, it's the recession's coming. And I think the market, I mean, it's like the boy who cried wolf. At some point, the market says, maybe these guys have no idea what they're talking about, including me.
Well, no, look, things have been more resilient than many have thought. And your point is well taken. I mean, look, when the Fed started hiking rates, it was recession, recession, recession. It never came. Now it's with the tariffs, recession, recession, recession. It still hasn't come. So I hear you on that. You still own the Mag 5 and a quarter of NVIDIA. The 5 being Apple, Alphabet, Meta, Microsoft, and Amazon. Now, you don't look at the market as a whole because it's hard to look at what the Mag 7 or Mag 5 are from a valuation standpoint relative to the equal weight. Are the Mag 7 overvalued? And if there is one that is, which one is it?
I mean, it's not that. I mean, the only one of the Mag 7 that I sold was Tesla. And I didn't sell it because I thought it was much more overvalued than the rest. It's because I wasn't comfortable with the fact that it had become a political play rather than an electric car play. So I think, to me, that when I look at the Mag 7 and I look at the capacity to I mean, you look at the margins that these companies deliver, and they're able to do it on a sustained basis. You're paying for cash flows, but I think you got to be realistic. At this point in time, the Mag 5 that I have are not the ones that are going to deliver 50% returns for me, but they're still at the heart of my portfolio. They deliver the returns. I think of them as mature cash cows at this point. And I think, and I'm paying for them on that basis. Solid, stable cash flows. And I think that's what people should recognize when they invest in them. You're not going to get 20% growth in these companies going forward, no matter what the tales are about AI in these companies.
All right, we shall see. Professor, good to see you as always. We'll see you soon. Up next, the Lakers record-setting sale. Our Mike Ozanian joins us next. from Showtime to Show Me the Money. The Los Angeles Lakers selling this week for an eye-popping $10 billion valuation, the most ever for a professional sports franchise. CNBC senior sports reporter Mike Ozanian is here with more. It's good to see you. $10 billion. I mean, how does it get to 10? We had him at CNBC Sport at 7.
That's right.
Not that long ago.
No, you're absolutely right, Scott. And what's really interesting about this, every NBA executive I spoke with, an owner, was completely shocked by this deal. It came out of the blue. You're talking about valuations a lot on your show. This is 18 times revenue. Previous highs, you look at the pending Celtics sale, Phoenix Suns sale. We thought those prices were high at a little over 13 times revenue.
The new buyer is building a empire of sports properties.
Yeah, he has. He's got involved with European soccer. He's got involved with auto racing. He already owns the Dodgers. And I think the limited partners looking to come in with this are going to spend time looking at the success he's had with the Dodgers, building the brand up, building the business up. Great model and track record with the Dodgers.
Dolan and MSG, they look at this and they say, are they on the phone calling the bankers? What are they doing? What are they doing?
Did you see the stock price the last 2 days of MSG Sports? It's popped. The market's been down. Absolutely. And I think there are two other teams really looking at this. One is the Golden State Warriors. They're exploring possibly selling a limited partner share. The Warriors own their building. They control the economics. The Lakers do not. They do not control the economics, so the Warriors have a bigger advantage. And the Portland Trailblazers, as you know, they're for sale. We're going to really see if this deal affects the Trailblazers, which at CNBC we valued at like $3.6 billion. Then we know this isn't just a big market phenomenon with the Lakers and the $6.1 billion Celtics price. This is spreading throughout the NBA.
Thanks for being here. It's an amazing story. Mike Ozanian. Thank you. It's been a roaring comeback for the IPO market. Vista Equity Partners, Ashley McNeil, right here next.
Question, just to wrap it up. question just to wrap.
Centers.
The IPO market has come back to life in a big way in recent weeks as several offerings have surged. So is it a sign of even greater things to come? Let's welcome in Ashley McNeil, head of equity capital markets for Vista Equity Partners. Good to see you again.
You too.
You saw what's happened in the last couple of weeks and said what?
I said, we're back, guys. We're back.
Are we? Are we?
Look, I think it's too soon to call a normalized IPO market, but it definitely feels like we're making strides to return back to something healthy.
I mean, we've had this conversation so many times about companies staying private for so much longer than they ever used to. And now you look at valuations of some of these private companies like the OpenAIs, when you say it's going to $1 trillion in the private market. Will this force companies to get off the bench and now access the public markets, or do they not need to, as OpenAI is proving?
I think it's sort of two separate paths. So for a functioning, healthy IPO market, you need to have investors willing to deploy capital. You need corporations able and willing to report consistently their earnings, and you need market certainty. I would argue in this market, we have 1 and 2. Number 3, I think we've found pockets of certainty. So we've had investors find certainty in the uncertainty. However, we also have created, through capital innovation and funds flow, a really unique market in the private market. And I do think there are going to be companies, bespoke companies, unique companies like OpenAI, as you mentioned, that will stay private for longer because they have liquidity.
What's the outlook as you see it for software, your bread and butter business at Vista Equity?
We think that software continues to be a fantastic place to invest for all of the reasons we've talked about before: predictable business model, really able to capitalize on generative AI, and really the center or nexus of like the data, the workflow, the automation. Software is going to be the ultimate beneficiary of generative AI.
Are we moving, though, beyond all the belief in what generative AI can do? Because we've seen, real examples, and now it's going to be all about agentic AI when you take the human equation sort of out of it. I know, Robert Smith, who runs the firm, is really bullish on that.
Well, yeah, we think about software sort of in 3 buckets, and it's a little bit linear about how far along are they. The first and foremost is agentic AI, as you talk about, having actual agents think and do and perform tasks. Then the second bucket, which is actually where the bulk of software companies exist, which is this moving from rule of 40, which is, adding your top line growth plus your margins, adding up to some number around 40. That's going to move to 60 or 70 as they deploy generative AI to really enhance their margin efficiencies and top line growth. And then there's a third bucket, which is software companies that haven't yet embraced the technology and aren't quite up there, and they may lose the right to win.
Interesting. All right. So the race is on. We'll talk to you soon.
Yeah.
Ashley,
great.
thanks. Ashley
Thank
McNeil.
you.
When we come back, a sector that's been on a tear, having its third positive week in 4. Do you know what it is? We'll tell you next.
doctor today.
Coming up next, Mike Santoli standing by for his last word, plus a sector check on one of the best performing groups this week. The Market Zone is next. We're now in the Closing Bell Market Zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus Leslie Picker on the big bank stocks making moves. Mike, we begin with you first as we head into the weekend. What's on your mind?
It's a pretty listless showing. I don't think you would necessarily look at it and say, okay, we have something fresh to worry about. But I've all week been talking about last Friday's low in the S&P 500. That's when the market reacted to the downside on the Israel-Iran news. We actually cracked that low today just by a little bit. We're trading right in the zone of it at the moment. And it feels as if all of these wait-and-see situations, all of these kind of standoff debates about Fed policy, what's actually going to happen, trade and tariffs, obviously the Iran situation, they didn't get better over the course of the week. So I just wonder if the market is getting fatigued from treading water for basically a month now.
Maybe it's content that it just didn't get worse either. So
that's right. And there's something to be said for that, basically. It sort of worked off this overbought thing, and now we're kind of consolidating at a pretty high level.
Yeah, Leslie, what about the banks? Been on a nice run of late.
Oh, absolutely. Banks by far the best performing industry in the S&P this week. The group up more than 3% week to date. boosted in part by speculation that there will be an easing of one of the big banks' capital requirements. It's known as the enhanced supplementary leverage ratio, the minimum amount of capital banks need to hold as a percentage of their assets, including U.S. Treasuries. Regulators are reportedly set to reduce the buffer by 1.5 percentage points for the largest firms. Regulators hinted that they support the rollback to boost the industry's ability to serve as intermediaries in the Treasury market in the event of a crisis. The Fed and FDIC plan to meet separately next week to discuss the plan. Also next week, bank stress tests will find out how the biggest banks performed against a hypothetical downturn, and the results will dictate how much the banks can return to shareholders in the form of dividends and buybacks. So potentially some optimism there as well, Scott.
All right, Leslie. Thank you, Leslie Picker. You know, I'm thinking about Mike catalysts, potential catalysts. If the Fed governor coming out and saying, "Hey, we should hike next month," cut next month, doesn't do it.
Yeah.
With all the Fed speak that's likely to come in the days ahead, what's the catalyst?
I almost wonder if that absolutely clear position on the dovish side by Governor Waller doesn't just highlight what deeply split opinion there is within the Fed committee, because nobody else is close to that. So I feel like the market's having to come to terms. That's right. Look, nobody dissented. We know what the dots look like. It doesn't feel like the committee as a whole is rushing to cut rates, whether they should or not. And there's a case to be made that they should lean that direction. I do think that it's just a matter of the market being frustrated that the lack of resolution on all these fronts. I've been pointing to July for a while. You're going to get the tariff pause expires at that point. We need a federal budget. It should probably start to come together in July. You do have that late July Fed meeting. All these things that kind of blend together at a time when the market sometimes, kind of loses some seasonal tailwinds. I don't think it's major. I still think you look at the index and everybody would have said a pullback of a further 3%, which, on the chart looks like the absolute ideal type of pullback from here, would be no big deal. The thing is, it's been just sort of like leaking sideways for so long. It would probably feel like we were having a little bit of a change of narrative if we did get that 3% in a hurry on the downside.
I guess we'll be watching yields more than anything.
Yes.
They did move up on Powell. They're 4.9 on the 30. Dropped down a little bit.
I think you're in the range where it's just kind of okay, nothing much to see here yet.
Yeah.
Leslie talking about the banks. I see Goldman Sachs up another 1% today. The investment banks and brokers are clear leadership. Usually that means the market is in a decent spot. You got these IPOs that are going wild. You even have old stale IPOs from a couple of years ago that are waking up because the speculators are saying, it's a low floater, it's a heavily shorted stock, and they're running. I don't know if that's healthy, or if that's sort of introducing some kind of erratic energy into the market, but it's clearly the case that if there was any glimpse of kind of like a green light for further deals, if we get rate certainty, if you get some kind of policy certainty, I think the market's kind of revving to move in that direction. If it sees the opening and there's lots of IPOs to come, we'll see if that can carry the whole market or if that's just a sideshow.
The pendulum has swung so far, to your point, that now we're hearing people talk about SPACs again.
Yeah, it's back for sure.
True, they're back.
They are back, and it's usually not the first SPAC that does it, but one of them is going to be the bell that rings.
Good stuff. Have a good weekend. That's Mike Santoli. We'll go out a little mix here as the bells ring. And all of you as well, have a great weekend. We'll see you on the other side. Windows T.
Well, that's the end of regulation. American Integrity Insurance Group bringing the closing bell at the New York Stock Exchange. DocGo doing the honors at the NASDAQ. Stocks closing mixed on the session, with the Dow eking out gains. Now for the week, the Dow and NASDAQ posting modest gains, while the S&P, it looks like finishing mostly flat. We'll see where it settles out here. Healthcare and materials were the laggards for the week. Financials and tech led. After a flight to safety last week, gold snapping a 2-week winning streak, posting its worst week in nearly a month. Silver taking a breather too. But Coinbase and Circle continuing their torrid rally as this so-called stable coin summer unfolds. Coinbase set to close higher by 26% this week. Circle up 81% this week. With today's move, Circle's market cap is now about even with, get this, FedEx. Kroger, the top performer in the S&P today, thanks to strong earnings. The grocer hiking same-store sales guidance. Accenture, though, that was the worst S&P performer. The tech consultancy lower despite a beat and raise thanks to a 6% drop in new bookings.
And that is the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Ford alongside Morgan Brennan. Ahead, San Francisco Fed President Mary Daly will get her take on this week's decision to hold rates steady and how tariffs could impact inflation and much more.
Plus, Meta's chief technology officer on the AI talent wars, where the tech is headed, and the company's push, plus his own, into defense as a partner with the military.
And a CNBC investigation. Are states giving away too much to lure data centers?
But we begin with the Federal Reserve and their possible next move. So let's send it over to Steve Leisman, who's joined now by San Francisco Fed President Mary Daly. Steve.
Thanks so much, Morgan. Yes, we are pleased to bring in San Francisco Fed President Mary Daly. President Daly, thank you so much for joining us.
My complete pleasure. Thank you.
Well, great. Let's start off with this issue of inflation versus employment and where you stand on the conflict or the contrast or the tension between both sides of the mandate, given the tariffs that are coming and what you have seen in the employment data.
So right now I see that things are in pretty good balance. We have inflation continuing to come down and the labor market remains solid. We're watching both sides of that information, of course, but so far the economy remains in a good place and policies in a good place. If you think about what could happen on inflation, there has been quite a number of concerns that the tariffs will push up inflation. But every day we get additional news that so far they're not seeing that the tariffs are coming down, that indeed the announced tariff rates are coming down. And then indeed what's happening is that firms are finding ways to mitigate some of the impact on consumers. So we still have to watch and make sure that we don't see it in inflation. And my eyes are on that. But I don't think the concerns are as large as they were when the tariffs were first announced.
Well, give me your read then on the May inflation data. Did you feel like you were out of the woods, stepping out of the woods, in something of a clearing in the middle of the woods? I know you like to hike, so give us your sense of where we were from the May data, and then kind of a sense of, well, where you be hiking this summer?
Okay, that's a great question, and I do like hiking. So the May data just confirmed an ongoing pattern that in the services and other sectors we saw, housing in particular, we saw inflation continue to come down. This is great news, both for our inflation mandate, but also for American families. So this is really good news. In fact, the fundamentals of the economy, the ones that are absent looking forward to the impact the tariffs might have, are really good. We would be considering, in my judgment, starting to normalize the interest rate with the labor market slowing and inflation coming down gradually. Of course, what we saw last month is not a predictor of what we'll see in coming months, just because we do have the tariffs and we do have immigration policy. We do have, tax policy and deregulation, all of which can have some type of an effect on the economy and inflation. And so we have to continue to watch that going forward. Now, again, I said the predictions of what that might look like from models in history can be pretty dire in terms of how much it will contribute to inflation. But there's also many things that can happen, leakages, wedges that get in between what is the published effective tariff rate and what actually passes through to consumers and households. So there's just more to watch, but we cannot wait so long that we forget that the fundamentals of the economy are moving in a direction where an interest rate adjustment might be necessary.
Do you see a meaningful, and I want to pick up on that in just a second, but do you see, as the chair put it, a meaningful increase to inflation coming in the summer months?
Steve, it's a great question, and it's certainly a possibility. So I see three possible scenarios as really driving the landscape of what we need to look at. One is that this has just been a delayed effect, that we're going to get a meaningful increase in inflation. And then the question there, is it going to be persistent and we really have to lean against it? Or is it going to be a one-time event that, we can look through? But the third possibility is really that, perhaps it won't have the big impact on inflation that we that models in history would tell us, and that it will be less response or less impactful on inflation. For that, we're just going to have to wait and see and collect more information. There's a lot of information we'll be able to collect to make those decisions. And we spend a lot of time talking to CEOs of businesses across the country, the Reserve Bank presidents. That's one of the features of reserve banks, is we're out all the time. When I talked to CEOs just today, I heard a little more optimism, cautious optimism, of course, but a little more optimism of just what will eventually be the tariffs they have to pay, and then eventually what they'll be able to not have to pass on to consumers.
So could a July rate cut be on the table for you, President Daly?
I think we want to be thoughtful enough to collect the information, and we do have these 3 scenarios that could unfold. So for me, I look more to the fall. And by then, we'll have quite a bit more information. And businesses are telling me that's when they're going to look to for some resolution to some of the uncertainty. So I think unless we saw a faltering in the labor market that was meaningful and we thought it would be persistent, then I would say the fall looks more appropriate to me.
Mary, great to have you here on Overtime. You were mentioning immigration. I'm wondering, are you yet seeing any impact of immigration policy on labor availability, on wages? And if not, where and when would you expect that to show up in the data?
We really haven't seen an impact on wages. Wage growth is coming in line with our long-run values of inflation and productivity growth. And we do hear of pockets where there have been some disruptions to the ability to get labor. I think this is something that's reported nationally as well on, maybe hotels or other entertainment venues. But right now, we haven't seen a broad impact, and that's so far. You might continue to see it, but what's happening at the same time that some of this immigration policy is taking place is that job growth is slowing, and so we don't have a lot of mismatch there. The unemployment rate remains low, and people are finding jobs. That takes a little more time to find them, but I don't hear of a lot of shortages. In fact, firms are telling me that they have an easier time finding workers today than they did just last year.
So if we stick with labor, Mary, and it's great to see you, it's Morgan. How about the impact of AI, which I know you're studying and you are interacting with the technology? We know Fed Chair Powell earlier this week said it's too soon to tell, but how are you gaming that out?
Absolutely. It's a good question, and we do study it, as you know. And what we're hearing, we talked to a lot of CEOs about this. We have regular roundtables, and what they tell us is they are using it. What went from something that seemed like it might work to something that's really affecting how they think about implementing it in their businesses. But again and again, they repeat to us that this is not a way to reduce their payrolls as much as is the way to augment their payrolls. They had a really tough time finding workers, and they want to make sure that those workers can do very productive things. And so they're trying to take less productive activities off, things that they can do easily with AI and don't present any risk to their profitability or their reputation. So we're not hearing of job losses yet, but certainly a wait and see approach is a good thing. We've had history of technology where specific people or sectors are affected, but I always remind people there hasn't been a technology in the history of technologies that has reduced net employment overall.
President Daly, I just have a couple more questions for you. Do you feel confident enough in some of the theories that are out there about the idea that, well, a tariff is a tax and a tax you ought to look through, and you could go ahead and cut rates even while inflation is higher because you're confident enough in the theory that that tariffs will pass through and not create a broader inflation issue?
Steve, I've done this job long enough and I've been economist long enough that I never trust just the theory. There's really 3 things you have to look at. The theory helps us. History also helps us. And then you have to talk to people. People live in the economy, and businesses are really sophisticated at knowing when they can pass things through, when they can't. Consumers will tell you, am I going to pay that or not? Right now, I think there's a lot to be said for it can be one-time thing, and you put the tariffs on, they find workarounds, they move on, and we don't have a persistent inflation growth. But I think that we just can't call that for sure, and I wouldn't be preemptive. I really look to balance the 2 goals we have, which is inflation, bringing it gradually down to 2%, and the labor market, and both are at the top of my mind.
President Daly, you've been a fan of using the phrase, which is also used by the Fed chair, of policy being in a good place. But I'll just give you my observation that it sounded to me like you're maybe a little less certain when it comes to the employment side of the mandate that the policy is in a good place. Could you just put some detail on that for us?
Well, I'm definitely not uncertain that policy is in a good place today, even with the labor market considerations I've raised. What I'm saying is that if you ask me where we are in the labor market, I would say we're at a point where additional softening could easily turn into weakening, which I don't want to see. And we can't allow for that to happen because we're waiting for inflation to pop up just around the corner. Central banks are very good at fighting the last war. The last war was we missed on inflation because we said it was transitory. I don't want us to lose on this one because we think it's coming, but it doesn't come.
Mary Daly, happy trails this summer. Thank you so much for joining us today.
Yeah, thank you for having me.
And Steve, thank you as well.
John, back to you.
All right, thank you. We got a news alert out of Washington. Megan Casella has that for us. Megan.
Hey, John, we just had a chance to hear from President Trump today speaking to reporters outside of his golf club in Bedminster, New Jersey. And there's really three top headlines that I see here, all on the ongoing conflict between Israel and Iran. First, the president was asked this question of whether he might ask the Israelis to pause their strikes. It's something that the Iranians have said would show that the U.S. is serious about negotiations. He was asked that question. Here's what he said.
But we're ready, willing, and able, and we've been speaking to Iran, and we'll see what happens.
What was the thought process behind 2-week timetable?
Just time to see whether or not people come to their senses.
He had said there it was very hard to make that request of the Israelis to pause their attack, saying if somebody is winning, it's harder to do that than if somebody is losing. So not suggesting he's likely to ask the Israelis to pause their attacks right now. Two other pieces. He was asked on Israeli Prime Minister Benjamin Netanyahu made some comments today that the Israelis on their own would be able to take out Iran's nuclear capabilities. The question there is why would the U.S. then get involved if Israel could do that on their own? The president said the Israelis really have a very limited capacity. They could break through a little section, but they can't go down very deeply. And then finally, he was also asked what intelligence he has that Iran is in fact building a nuclear weapon. He has said they are, but there's been some mixed opinions coming from the U.S. intelligence community, including from the director of national intelligence, Tulsi Gabbard, on that. He was asked about it, and the president replied, quote, "My intelligence community is wrong." So standing by his assessment there that the Iranians are in fact building a nuclear weapon and very close to doing so. Guys.
Megan, thank you. Coming up, we'll get instant reaction to Mary Daly, the San Francisco Fed president we just heard from. Fed Governor Waller also saying this morning the Fed could cut at the July meeting, but we just heard Daly said she sees the fall as more likely. So when will the Fed make a move?
Plus, why this building materials company is at the center of a multi-billion-dollar bidding war. We're going to break that down. Overtime's back in 2. Welcome back to Overtime. We'll take a look at shares of GMS. The stock soaring after a bidding war for the company developed between Home Depot and QXO. The move is Home Depot's latest attempt to diversify and take more control of its supply chain, betting big on distribution that expands its business with pros. This is something actually Home Depot's CFO, Richard McPhail, discussed with me recently on Overtime. Now, Home Depot's bid for GMS comes after last year's $18 billion deal for roofing distributor SRS. But other building suppliers like Blue Links, Installed Building, Top Builds, those all moved higher on the news as well. John, I'd also just note that despite the reports about all of this, Home Depot has not commented publicly on its bid in this process, but it still spiked shares up double digits today.
Interesting. Okay. Well, let's get back to the market as well. We just heard from San Francisco Fed President Mary Daly. Here's what she said about where the economy stands right now and on the Fed's two main goals to keep inflation tame and employment full.
So right now I see that things are in pretty good balance. We have inflation continuing to come down and the labor market remains solid. We're watching both sides of that information, of course, but so far the economy remains in a good place and policy's in a good place. If you think about what could happen on inflation, there has been quite a number of concerns that the tariffs will push up inflation. But every day we get additional news that so far they're not seeing that the tariffs are coming down, that indeed the announced tariff rates are coming down. And then indeed what's happening is that firms are finding ways to mitigate some of the impact on consumers.
Let's get reaction from our guest, Charles Schwab Senior Investment Strategist Kevin Gordon. Kevin, good to have you here. So you heard Daly saying things look good now, but you've also talked in the past about the impact policy uncertainty is having on business confidence. How do you see that playing out in the markets for the rest of the summer?
Yeah, well, so far, I mean, the uncertainty has been more on the survey-based side of things, where you look at things like capex intentions and the lack of capital spending that's at least planned for companies because of the tariff policy uncertainty. I mean, I would characterize it maybe less as uncertainty and more as instability, because that's probably more of a fair way to characterize it. But as it I think pertains to markets, the way we think about it is path of least resistance from the beginning of the year for tariff rates is higher, but path of least resistance from the ultimate peak has been lower. And I think that's been more of the focus, since the April 8th lows for the S&P 500. Clearly, the reversal or the pause in the high tariff rates was what has driven, or has been a big reason of what has driven us, off those lows and back near record high territory. So from here, our thinking about this for the back half of the year or going into 2026 is, how does the market digest a higher tariff rate, effective tariff rate than what we had at the beginning of the year, but how does that ultimately weigh on the economy, in particular the labor market? I think that's what I was really paying attention to during Mary's interview was, what is that line between softening and quick weakening in labor? And I think eventually in the back half of the year, that's going to be the metric to focus on, and things like the unemployment rate, which has, by the way, risen every month this year so far, if you take out a couple of decimal points.
How are you factoring in the various unknowns, including what the ultimate tariff rates will be with the most important partners, what's happening with consumer credit, how that might affect the back half of the year, especially Q4, and then how much inventory has come in already ahead of those expected tariffs coming on full force? Yeah,
the inventory story and the export-import differential is going to be a huge driver of GDP volatility this year. I mean, you're already seeing it from first quarter, weak headline GDP, but underlying business investment or consumer spending was strong. You're probably going to see not a complete reversal in the second quarter, because we still think that business spending and consumption will remain relatively healthy, but you're probably going to get a pretty significant jump in GDP because of the reversal of the export-import data, and probably a reversal of some of the inventory data too. So you're probably going to have maybe 2025 as a full year of those kind of swings in GDP. So it's going to be less focus on the headline, more focus on the underlying subsurface activity. But we would view almost all facets of economic data that way, especially company earnings. Don't necessarily look at what the top line or the bottom line is. Even look at the guidance and how companies are approaching tariffs and what they're doing to sort of stomach some of the volatility. And because because even within sectors, if you look at consumer discretionary, if you look at consumer staples, companies have had very different reactions to tariffs and how they've been able to digest them, whether it's passing it on to the consumer because they don't have the buffer to do it, or the buffer to take it in their margins, or taking it in the margins because they built up enough of a buffer, going into this.
Yeah, I thought that was interesting too. And Mary Daly made that comment that some of the CEOs she's spoken to have said that even if they're taking on more costs tied to tariffs, that they're not pushing it out to their end users as well. So a dynamic to watch. How do you assess and navigate geopolitical risk? And we're going into the weekend. It's a little bit calmer based on the president's headlines we just got, but it's certainly not over.
Yeah, I mean, it's a new normal. It seems, unfortunately, to have so much, tension around the world and literally, wars that are happening. Now we've got 3 really to track. I think that as it pertains to U.S. growth and the hits to eventually to U.S. markets and the economy, clearly everything runs through the energy channels. So that's why there's been so much focus on whether the Strait of Hormuz is, actually closed or blocked, and that starts to affect how global oil is shipped around the globe. If that doesn't happen, you probably have, a little bit more of a buffer for the economy, at least in the U.S. And I would add too, if you look at energy spending and the share that it commands as a percentage of overall consumer spending in the U.S., we've come down from a peak of just above 9% in 1980 to 3.5%, 3.4% now. So you're not going to see as much of a pass through to the consumer, for various reasons. I would say the number one being that we've become a net oil exporter, and we've become a little bit more, energy dominant and independent. So there's less of a pass through effect there. But as geopolitical tensions, go as far as they go, that's probably where you see most of the hit, if at all.
All right, Kevin Gordon, thank you.
Good to see you. Thank you.
Well, the S&P 500's up 6% since the start of April, but as the quarter comes to a close, is there something happening in the market that could jeopardize those gains? Mike Santoli is going to join us on that.
Plus, Palantir, it's up 440% in the past year. By far the best stock in the S&P 500. With gains like that, it's no wonder other tech giants are trying to get into the defense space. We're going to be talking to Meta's chief technology officer on his recent induction into the U.S. Army as it looks to speed up its technological reach. Lots to talk about there. Overtime is back in 2.
Oh.